Daniel, general concepts here. Do you get to keep the cash value from your high cash value policy when you die? Or not you keep it, but your heirs keep it? Answer is yes and no. So, and not even whenever you die. Let's just say in general. You get to utilize the cash while you're alive. So that loan will go against the policy. It will decrease the overall cash value, will decrease the death benefit dollar for dollar. The true definition is, well, I won't call it definition. Maybe it is, maybe it is. The death benefit is all you really have. So the death benefit by default has a certain amount of cash value that it accumulates based on the product. So if you have a whole life policy, especially if it's designed as such, and they're all going to, as long as you're with a mutual dividend paying company, you will always get dividends, whether it starts early and it's very small, or it starts, or maybe it's very small, maybe it's not, depending on the structure, or maybe you start with a policy that starts off very slow, but in the later years, every year you're getting more dividends because it's the structure. Again, there's two places your money can go. It can go into what's called the base premium, and go into the paid up additions rider or paid up additional insurance. That paid up additional insurance is where most of your cash value comes from, especially in the early years. In the later years, depending on the company, a lot of companies have it to where they pay more dividends on the base premium. That's not all companies, but that is some companies. And so you will get more in the base premium. So what a lot of people will do, especially people doing infinite banking, they will pay into their paid up additional insurance and their base, because you have to pay the base premium because that's what keeps the policy going. You pay the base premium, then you put money into, then the rest of your money goes into that paid up additional insurance. And then after about 10 years, they'll usually stop and they will only pay the base premium, because at that point, the base premium is paying a good amount of money. So in dividends and interest, so it really comes out better off that way for a lot of people. It depends on what your mission is. It depends on what your use is. What are your needs? If your needs are that you want to pay most of your money into base premium, but you still want to utilize infinite banking, for example, you want to be the bank kind of thing, or whatever you want to call it, privatized banking, you want to have that cash up front. So the upfront cash will allow you to utilize that cash and have, that is one of your living benefits. The other benefits of life insurance are, depending on the company again, or whether or not it's included or it's additional, you can have critical and chronic illness, critical, chronic, and terminal illness as an additional benefit, which will take you all the way up to the whole death benefit, depending on the company. Some of them let you use up to 100%. Some are up to 50%. So it just depends. It depends on the company, but that's a living benefit. Obviously, the other benefit is that you're leaving this legacy behind of a certain amount of money. So do you get to keep the cash value? Yes and no, right? I say people will tell you no if they're trying to, they'll tell you no if they are trying to, sway you maybe towards another product in some cases. But you do, because it's all death benefit, and by default, a portion of that is cash value. So don't believe the hype. It is a death benefit is a death benefit, but in this case, in this product and whole life that we're talking about, that people seem to talk bad about or think bad about is not as bad as what people think, because it's the same amount. $1 million death benefit is $1 million death benefit, whether there's $500,000 of cash value in there or not. Maybe there's no loans and it's $500,000 of cash value. The full $1 million is still going to be paid. So, some people are like, oh, well, if you do it this way and that way, yeah, that depends. There again, it depends. You can't compare apples and oranges, right? They've got to be the same thing. And then you've got to take into account all the little things, all the fees, all the costs. There again, it's kind of like buy term and invest the rest. Sure. But term runs out at a certain point, costs go up quite dramatically whenever that runs out typically. And then what happens is that you additionally will be in a situation where you've got to add the cost of that insurance on top of whatever your gains were, whatever the fees on that product was. So say it's a mutual fund, it has certain fees, and then there's a money management fee for whoever's managing that money. So say that's another 1.25, maybe 1.5. Some people say it's higher. I'm going conservative. 1.25 to 1.5 is not unheard of. You've got to take that into account. And how much money that is over, say 30, 40 years, whatever it is that you have your money in there. So is it the same? Is it different? I mean, there's, again, it's based on need. It's based on the client. It depends on risk tolerance. I mean, risk tolerance at the end of the day is also going to dictate some of this. Please like, subscribe, click the notification bell. If there's any questions I can answer, or if you want to schedule, get on the calendar, ask me your questions, or you can put questions into the comments. I will make content about it. If it's something that I can come up with enough content about to make a video, I sure will. And if it's something that's specific to you, please reach out to me either by phone or by scheduling on my calendar. And like I said, the links are below. Have a good one.